You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music can mean only one thing. It is Wednesday. Hashtag Education Wednesday here on the network, so you can get a good dose of your favorite Options Bootcamp, Options Playbook Radio coming at you later today as well. So a lot of education coming at you here on Education Wednesday. If you like what you hear for this program, for anything else on the network, make sure you keep those reviews coming. We love to see all the new ear holes joining us week after week out here. We want to keep that flow coming. It's more important than ever in these crazy and turbulent times here to have a reliable, a sane source of information on these markets. So if you like what you hear, leave those reviews, those comments on your platform of choice so new folks can continue to discover the program. And of course, keep those questions coming. We do love to hear from you guys. And let's see who we're going to hear from today on the old program. I do think I am joined once again, yes I am, by the black-hatted one himself, Mr. Dan Passarelli, the founder of Market Taker Mentoring and the author of one or two options-oriented tomes. Mr. P, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
I'm glad to be back. I wouldn't leave you hanging at all, Mark. You know that.
I do know that, and I also know it is time for a little basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, you're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, Pull in, prepare to learn.
All right, everybody. Welcome to Basic Training, the portion of the show where we break down a basic options concept or strategy or educational element and explain how you can utilize it in your own options portfolio. And today, Dan, we're going to the brave side. We're getting away from the cowardly trades, and we're going brave because we're going to talk about iron butterflies. Now, you may remember a related strategy we discussed a couple times on the show, most recently back on episode 90. Check it out if you're so inclined, listener. That's, of course, Iron Condor. That's a strategy a lot of you like out there. They were super popular, I'm going to say, about 5 to 10 years ago. Iron Condors were all the rage. They seem to have waned a little bit. Maybe the protracted bull market of the past few years have had something to do with that, but they're kind of getting back in fashion a little bit. So we broke them down for you on episode 90, but we also talked about and joked. There was an old adage that an old cohort of mine on our Volatility Views program used to say, and that was that iron condors are an iron butterfly for cowards. So we're not going to be cowardly on the show today, Dan. We're going to talk about iron butterflies themselves. Are you ready, Mr. P?
I was born ready, Mark. Let's do this thing.
All right, let's do it. Let's start off. I don't know. Are you a big iron butterfly guy outside of the band? I know you like the band, Mr. P, but outside of In-A-Gadda-Da-Vida, do you have any use case really for iron butterflies, sir?
I was playing the live version. Hold on a second.
Oh, great. There we go. There we go.
How many seconds to play before we
get kicked off all the platforms out there? That's going to cost us about $100,000, but it was so worth it, sir.
Indeed, it's only money. We can make more. We're traders, right?
Exactly. That's what we do here.
Yeah, I mean, honestly, I'm a fan of both. I like iron condors and iron butterflies.
So you don't subscribe to the iron condors or an iron butterfly for cowards thought process, sir?
No, I would rather be a coward with some money than than a brave broke guy.
There is something to that. That's for sure. All right, let's get into what the heck we're talking about here. I've heard various reasoning behind why the heck they're called iron butterflies. Outside of the song, do you have any insight into why the heck they're called that, sir?
Well, I mean, I guess the butterfly part comes from, like, if you look at the profit and loss diagram and you're really high, it could kind of look like a butterfly. But you need both in order to actually be able to see that. And as far as the iron goes, yeah, it's kind of weird because, like, if you think about how, like, it should have been called, like, iron is, like, heavy, but really you're using the out of the money, so you're stripping out the synthetically unnecessary guts, like intrinsic values. So it seems like you ought to call, like, the spread where you use the intrinsic Z in the money because there's, like, much more premium to weigh it down. I don't really. I'm just musing over here, man.
Yeah, I know. The terms, people always ask on shows like this, particularly for the ones with the basic retail, where do these names come from? Front spreads, back spreads, iron butterfly, all these crazy things, jelly rolls. And the truth is, for a lot of them, the origins are lost to the mists of time. This is one in particular. Options were born in 1973. Iron condors and iron flies weren't around back then, listeners. But this is kind of the era, the context in which some of these names had some of their early origins. So bear that in mind maybe for some of these naming conventions here. But we're going to get to what the heck we're talking about. Remember, let's start with what we talked about in episode 90, the iron condor. That was effectively 2 out-of-the-money strangles. If you want to think an underlying is going to move quite a bit, everyone's favorite XYZ. Well, let's say you want to buy an out-of-the-money strangle. Let's say XYZ trading at about $100, and you think it's going to move a little bit. So you're going to go for, let's say, the 90-110 strangle, so 10 points out of the money. And then you're going to sell, maybe say another 5 or 10 points out of the money against that. So you have 2 strangles, one hedging the other. Vice versa, if you want to sell it, you're selling the out-of-the-money strangle, and you're buying a farther out-of-the-money strangle to protect it. That's the iron condor. Again, check out episode 90 for an overview of that. But we're going to go a little bit darker, a little bit closer to the fire out there. No cowards on this episode, listener. We're going to go iron butterfly. So what are we talking about now? Well, let's break it down. Let's use our old friend again, XYZ. We've all made and lost fortunes in XYZ over the years. Hopefully, we're all going to make one in XYZ today. XYZ, for our purposes, trading at a nice round even $100 out there. And you think this stock's not really going to move that much for the next month. But you also don't want to lose your house if it does drop to, let's say, 30. So you come in, you're going to sell the iron butterfly. What is that? 2 legs. First off, you're going to sell the at-the-money straddle going out 1 month. In our scenario, let's say the call's trading for $2 and the put's trading for $2. You get a nice $4 to sell that straddle. It's actually pretty juicy. You're getting 4% on that straddle for 1 month. Probably a pretty volatile name you're selling these options on. So if it's a volatile name, you probably want to hedge that in case that volatility is warranted. So you say, you know what? I don't want to lose the house. I'm going to go out a little bit farther. So I sold the at-the-money straddle, remember now. So that's at the money. That's decaying pretty rapidly. That's nice. But also every tick, the underlying moves away from that at-the-money strike, I'm going to lose some money. So I need to hedge this bad boy. So how do we do that? Let's say in this scenario, let's go out 10 points. So let's go buy an out-of-the-money strangle now, a 90 strike put and a 110 strike call. That'd be expensive the other way. And let's put those together. So now you have protection to the downside, listeners. You're protected if it drops below 90. You're stopped out. And you're also cut off to the upside here, or protected, really, at 110 in case it blows up to the upside. And let's say for our example, it's going to cost us about 75 cents for the put, 25 cents for the call. Why are they imbalanced? Remember, go back to our recent episodes about skew. Puts typically cost more in equities and equity indices than the calls do. So the put's going to cost about 75 cents. The call about 25 cents, works out to around $1. So what have you done now? You've sold the at-the-money straddle for $4. So you got $4 worth of wiggle room to the upside and to the downside. This thing vacillates. If XYZ drifts anywhere within that $4 over the next month, but stays within it, you're going to keep whatever the balance is. But you also paid $1 now to hedge that bad boy. So now you really collected $3. So your net income, your net premium you've harvested there is $3. So in reality, you have a 3-point window there now. But also, so if it stays right around 100, let's say in our example for the next month, you're going to keep $3 in your hot little hand. So every one lot you sold, that's $300 in your pocket. Remember, equities have a 100 multiplier on them. Now, if it drops below, in our example, we chose, what do we choose? We chose the 90, 110 strangle. So if it drops to 90 on the downside or 110 on the upside, you're going to lose $7. Because remember, you collected 3, but it's got $10 worth of juice against you out here. So your net going to have $7 worth of risk. That's not that favorable risk-reward scenario out here. But again, XYZ, pretty volatile. So that's why it's costing. So if it drops to 90 or rallies beyond 110 on the upside, you're going to be stopped out. Max you could lose on this trade is $7. So what's good about this? Well, we just talked about it. You're collecting $3 and you're selling an at-the-money straddle. That means you're getting all the nice at-the-money Greeks that you like. A lot of gamma, a lot of theta. A lot of theta means you're going to decay very rapidly on that at-the-money strike. So that at-the-money straddle is going to decay pretty quickly for you, which is a good thing when you're short it. On the flip side, though, you're short an at-the-money straddle. So every tick of the underlying is going to cost you money away from the 100 strike. So if you drift there away, you get up to 106, 107, you're going to net lose some money on this trade. That's why they say an iron condor is an iron butterfly for cowards. There's no cowards here. This is really all at the money stuff. So you have to really want it. You have to really understand the risks involved if you're going to trade this. Now, you can flip this around if you wanted to buy this thing. Instead, you buy it. So you're going to pay $4 for that straddle, and you're going to sell the wings against it for $1. So now you've net paid $3, and now you need this thing to run. You need it to run out to the wings and collect that full $7 on this trade out there. Remember, $10 spread minus $3 you collected, $7 in your pocket. So you can do it both ways, long way and short way. And those are two basic overviews of the long and short iron butterfly. Any thoughts on this, Dan, before I compare it directly to an iron condor, sir?
No, I think you're doing a bang-up job here, Mark.
Well, there you go then. Thank you. Thank you for that. So that's why I get the big bucks here. All right, let's go on to the iron condor now. Why do they call it an iron butterfly for cowards? Well, we're going to break it down here. Remember, instead of just doing that at-the-money 100 straddle, same underlying XYZ, now we're going to go instead and just do that out-of-the-money strangle first, that 90-110 strangle, and you're going to sell that. So again, in our scenario, that's worth $1. So you collected $1 to sell that. 75 cents for the put, 25 cents for the call. Then you turn around and buy, let's say, against it. Let's just go $5 beyond that. Let's go $115 and $85. So you're stopping yourselves out another $5 beyond that in case the worst happens there. And you're paying, in our example, 25 cents. So you sold the one out of the money strangle for $1. Second strangle you bought to hedge it for 25 cents. So net, you're collecting 75 cents. You have $5 worth of risk, though. The stock drops from 90 to 85 on the dark side, or from 110 to 115 on the upside. You're going to lose some money on that. In this case, $4.25. So again, not the best risk reward here on these, but these are just very straightforward, easy to understand examples out there. So what have you done there? You sold the 90-110 strangle. You brought the 115-85 strangle against it. So why do they call this for cowards? Well, effectively, you can see what you've done. First off, you've migrated about 10 handles away from the at the money. That gives you a little bit more cushion, a little bit more wiggle room. The stock can vacillate. It has to really run 10 handles before it really starts costing you money. So in that sense, that's why they call it an iron butterfly for cowards. You don't want to be there playing at every tick of the underlying. You want to give it a little bit of cushion. And that's why you went $10 around the at the money as opposed to the at the money themselves. But the downside to this, obviously, you just saw, you collect a lot less premium if you're selling it. So that's not attractive. And also, if you're buying it, you need a lot more movement in the underlying for these things to pay off, which is why some folks prefer the iron fly. They like to go straight to the fire, as I like to put it, versus the more removed, more cushioned iron condor. Dan, do you have a preference here, iron condor or iron fly, and any thoughts on these various use cases therein, sir?
I have a preference depending on the scenario. So Yeah, there's some interesting nuances to talk about here. One is, like I love wiggle room. There's nothing I love more than wiggle room because that improves your chances of having a winning trade. But the trade-off is that when you get that wiggle room, like you pointed out, Mark, you have lower profit. You take in a lower credit, so that means lower profit potential. But what's also important to mention here is that given the same strike width, when the credit ends up being smaller, then your maximum profit ends up being smaller, your potential loss actually ends up being bigger. So like one of the tenets that I always talk to our students about, and I've actually begun making a little list of them, is it's not risk reward, it's risk reward versus probability of success. And so we're always weighing that, in those times when you really need wiggle room, the iron condor is way better, but you get that sort of worse risk reward scenario. When you don't feel as if you need as much wiggle room. And one other element I'd like to inject here is when the trade is less than 10 days, going with an iron butterfly could be good as well. And I make that distinction. Iron condors, you can go out a little bit more, but with iron butterflies, the trade has to be within 10 days. Any trade that's longer than 10 days, maybe even 7 days, there's no theta. And the only thing that can happen is if there's a big move, you can lose money. I can elaborate on that if I went too fast on that last part, but that's a really important point, I feel.
It's interesting. I'm trying to think back now. Obviously, iron condors, do you agree they kind of had their heyday, I'd say maybe 5 to 7 years ago? They don't seem as hot now, though they're starting to make a little bit of a comeback. But I'm not sure if iron butterflies ever really had their heyday. I never really saw a lot of mentoring groups or services or even scammers out there hawking iron butterflies as a great way to trade. Maybe it's just too scary for people. So what do you think about that, Dan? A, do you think maybe the heyday of the iron condor is past, or maybe it's starting to make a comeback? And then B, can you think of a time when iron butterflies were ever hot?
So this is really funny. So when we were on the trading floor, I don't know what because what were you in the SPX pit?
I was in SPX and also Intel and a little bit of Microsoft.
Okay. So, I know like the nomenclature, for those of you guys who, haven't been down on the trading floor and know the inner lingo, like different pits can have different nomenclature for different things, like the equity pits might call one thing something, or the index pits might call it something different. And for me, when I was on the trading floor, I literally never heard the term iron condor. Like I never did. And then when I started teaching options for the CBOE, like one of my first groups that I took down to the trading floor, the guy's like, "Oh, tell me all about iron condors." And I'm like, Jesus, I was a professional trader for 7 years here. I don't know what you're talking about, man. We used to call them strangle swaps. And then iron butterfly, like a straddle strangle swap, I guess we would call it. So yeah, like right when I started teaching options, I would say 2005 is when that like the craze, the iron condor craze began to hit, and yeah, it did kind of fizzle out a bit. I think 2008 fizzled it out a little bit because if you had them on, you lost a ton of money. And then after that, the market just steadily climbed straight up, which is not really a perfect environment for a neutral strategy, like the people who just did nothing and sold puts made money, then. But yeah, as far as did the iron butterfly ever have its heyday, I would say no.
I think you're right about those retail-friendly type terms, right? Because we never really encountered them either on the floor. Right? No one ever said to me, hey, I want to quote this Iron Condor in whatever name I was in. There were a lot of swaps. You're right. They're like, 1-by-3 ratio, strangle swap, or risk reversals, or all these other things that were more of the professional grade terms. But these other things, you never really heard. Your rolls, you talked about a lot. You had to roll, especially in the SPX, you had to do a lot of rolling out there. But you're right. These other more retail type terms, Iron Fly, never really encountered them until you started interacting with the retail audience, and that's the nomenclature that they have embraced. And you're right, I think there is something to that of the general protracted bull market we've all been in for the better parts of the past decade. That's really kind of taken some of the teeth out of these neutral type strategies like an Iron Condor and even an Iron Fly. Why do these things that are a little bit more sophisticated, require a little bit more management and maintenance, when you could just, hey, buy a call? Any idiot could have bought a call pretty much over the past 5 years and done all right, as long as you managed it pretty diligently out there, or certainly just bought the stock and done all right. Look at crazy names like Tesla of late. So if you have those kind of low-hanging fruit things that are making money, kind of harder to advocate for a more nuanced type approach like the long or short Iron Condor, or indeed our friend, the Iron Butterfly. So if you don't want to be a coward, if you want to try out these strategies for yourself, that's exactly what an Iron Butterfly is. Of course, you can go back into our archives. We have longer discussions on all these types of spreads with wings. So the Iron Fly, the Iron Condor, the traditional butterfly, the skip strike butterfly, all the other good stuff out there on the spreads with wings. We encourage you, if you're new, and we know a lot of you have just discovered this program in the last few months, go back, check out the archives. I know a lot of you are doing that as well. If you have questions, hit us up. As we've proven here on the show, we're more than happy to discuss your epic treatises. Maybe we'll condense them a little bit. We'll discuss them on the show. Speaking of your epic treatises, let's see how many of you we could squeeze in our remaining minutes with a real quick mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. It's time for you guys to take the reins on the show with a little segment we like to call around here, the mail call. Let's kick things off. Actually got a timely one eating up a lot of people's mind share right now. Dan, obviously we're in the middle of a pretty interesting period in the market. Just about any given day that ends in Y these days is an interesting period in the market. But of course, we saw a pretty protracted pull-off in the broad markets into the last few sessions, multiple sessions of sell-offs, which is unusual for the better part of everything since March, pretty much here at least in the domestic markets. Now today we're seeing a little bit of a retracement of that. The market's rallying. I don't want to get too timely with this, but because I know a lot of people come to this show after the fact. But we do have an interesting debate going on right now, Dan. I'd like to get your thoughts out there right now. A lot of people weighing in. You guys can do so as well. At Options is where you find us on the old Twitters to make your voices heard. Last Friday, our old friend the VIX, aka the Fear Gauge, closed close to 31, about 30 3/4. So we asked you guys, hey, ticking up a bit. Are you guys buying this, or is this a mere blip on the radar? We gave you 4 choices for where you think VIX will close this coming Friday. So right about here, 30 to 33, a little bit higher, so north of 33, a little bit lower, 27 to 29.99, or much lower, south of 27. Dan, what is your vote? Then I will reveal where our audience is, what they're feeling right now, sir.
So this is for this coming Friday?
Yes, this coming Friday, sir.
Oh, this coming Friday. Oh, man. So, geez, this is a good one, Mark. I would say I'm going to go with higher.
So north of 33.
Yeah, north of 33.
I have to stay with that because my prognostication on our Volatility Views program was around a similar level out there. So I have to be drifting certainly in the here to higher category. And that's where our audience is as well right now, Dan, 35.7%. It's a pretty good split amongst the ranges, which, again, makes it interesting, makes up a market out there. 35.7% saying north of 33, 24.7% saying much lower, south of 27, 23.4% saying lower, 27 to 29.99, and right around here, 30 to 33 at about a 16.2%. Let's see where we are right now. And VIX is at about 28.5. So we're in the lower range right now. But of course, as we all know, anything can happen between now and Friday. Like Pro Thoughts said here, he said, when the VIX gets to 30, it will stall until expiration week, time decay on the options. Well, that does not seem to be happening here, Pro Thoughts. We are south of 30 as we speak, down to about 28.5. We'll see if it stalls out there or it's got more room to the downside, or like Dan and I have been wagering for the rest of the week here, a little bit more to the upside. All right, let's see who else we got here. We've got Android Enthusiast, so perhaps a fan of Android phones. He or she wants to know. He says, hello. Well, hello, Android Enthusiast. He says, I'm a new convert to options, and I've been working my way through your program. The last episode confused me a little bit. Dan seemed emphatic, he says, Dan, that retail traders should never gamma scalp. Why? It seems like a useful technique. Well, Dan, you are invoked here. He says you were emphatic. Why are you so emphatic that retail listeners to a show like this shouldn't be gamma scalpers?
I mean, hey, man, try it and come back and talk to me in 3 months and tell me what your P&L is. I think it'll probably end up being lower. And I say that, I mean, look, man, I made on the trading floor, I'm just not going to lie to you. I made a lot of my money gamma scalping. That's what I did. That's what I was really good at. That's what I like to do. And it was very, very lucrative for me to do so. And so I tried to teach some of my really smart, really knew what they were doing, really knew the Greeks, were well capitalized, had the time to put into using this time consuming strategy. And I did it with 3 of my students and I could not make it work. It's just there's a lot of things stacked against you. There's the bid-ask spread is stacked against you. There's your margin and your commissions are stacked against you. You know, like it's hard to short stock and not chew up a ton of margin, even with portfolio margining, I think. So I don't know. I mean, I love the strategy, but I think you're going to have a hard time doing it.
All right. That music means we've come to the end of this episode. And for Android enthusiasts, yeah, you know, I think Dan's advice is sage-like. I don't often say that, listeners, but today, why not? Go try it for yourselves. See how much capital is involved in doing this. Remember, we're talking about slinging stock against your options position, not other options trading to hedge or mitigate your options position, slinging stock against it. So you know off the bat, you're probably going to have 50% margin at the best out there. So if it's an expensive stock like a Tesla or an Amazon, good luck slinging a lot of stock against that, let alone a cheaper name that's probably in the more sane, shall we say, 100 range, like our XYZ today. That gets expensive really quick if you have all these other equity positions you're trying to put on and take off. But, you know, that was the way we made a lion's share of our money on the trading floor, was gamma scalping. So it is a very worthwhile technique to understand and to know. And it certainly will inform your trading. It's just difficult to do in most retail accounts unless you have a lot of capital that's sitting ready to be put to work. It's going to tie up a lot of capital. You're going to sell stock above a position. You're going to buy it back below. It also depends on your margin treatment, how your broker treats those as offsetting positions. A lot of things go into that calculation of how much capital this is going to tie up. But if you're savvy enough and you want to do it, try it. Have at it. Let us know how that works out for you. And Mr. Dan, unfortunately, that music means we've come to the end. But if folks are intrigued, maybe they have more questions about gamma scalping, or maybe why they're cowardly for trading iron condors versus iron flies, or any of the other things we talked about today. If they want to learn more, where should they go? What should they do, sir?
Yeah, come by anytime to my little piece of the internet that I like to call markettaker.com. Market, like stock market, taker, like take what is rightfully yours. 2 T's in a row, markettaker.com, and just hit the contact us button. And you know, I'm glad to help our listeners any way I can.
There you go. Check them out, markettaker.com. 2 T's in a row there in the middle. And you can ask him questions about all this good stuff and a lot more. And we'll see you, of course, back here throughout the week for all of our other programming. Tomorrow we have TWIFO. We have Option Block Part 2 for the week. Friday, we've got Vol Views. Of course, later today, we've got Options Playbook Radio, keeping the education train rolling on, and a whole bunch more. And it kicks off again next week on Monday with the old OB again and the crypto rundown. Tuesday, our interviews all the way through to another Education Wednesday and another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.